Hey there and welcome to the channel. In today's video I want to share with you some of my highlights from the latest Mohnish Pabrai videos, but I try to watch all of his videos that he uploads on his YouTube channel, and this one is only about 42 minutes, so I'd recommend watching the whole thing. I will leave the link in the description, but let's check out the first highlight.
You're looking at making an investment that it makes no sense. Either pricing is so euphoric and so extreme, bubble-esque type characteristics that you kind of scratch your head. And in those cases, you can just take a pass and move on. Or in the other case where the pricing and valuation is so extreme in the other direction that it also makes no sense. And because we invest in auction-driven markets have this peculiar characteristic that they can swing quite extremely in both directions. So if I were looking to purchase a home in Clemson or Anderson, basically it would be an intelligent seller facing an intelligent buyer almost all of the time. And you'd come up with some kind of intelligent price in a negotiated transaction. It would be very similar if you were trying to purchase an entire business. And again, it would be an intelligent seller facing an intelligent buyer.
Mohnish has a very good point there where he's talking about the stock market, which is auction driven. And that's why, in my opinion, we have the best opportunities for investment in the stock market versus other options, like, for example, real estate, where you have a lot of the time very intelligent sellers and intelligent buyers. So it's harder to get bargains there. And it's really the same thing with private companies, because the guys that are selling the companies, they know everything about it. And they usually know how much it's worth. The only reason you'd be getting a discount if you're buying a private company, it's probably because something is wrong with the company, like they have an unhealthy balance sheet or they're just losing money way too fast. But the normal state of the stock market is that everything is kind of fairly priced or overpriced. But we do see these bargains come along every so often. So we have to be ready to step in and take advantage of the opportunity. The latest opportunity of a clear bargain that I remember is Meta in the fall of 2022 when the shares went below 90. I remember calculating that the company would only need to grow about 3 to 4% for me to be able to get a good return on my money.
In the 2005 annual meeting of Berkshire Hathaway, Warren Buffett was asked a question. He had made a relatively large investment in Petro China. He never ever invested in China before. And so his first investment in China, and actually it wasn't that large, it was about a $400 million investment for Berkshire. Buffett said that at the time, Petro China was earning about $12 billion a year. It's one of the largest oil companies in the world. I think only maybe Exxon and BP would have higher earnings than that. Against this 12 billion of cash flow, the market cap of Petro China was 35 billion US. And they had pretty much written black and white in the annual reports that 45% of all cash flow would be pushed out as dividends. So he was buying at 3 times earnings, pretty dominant oil company. And it was something like a 15% dividend yield on what he was buying. He thought it was a no-brainer bet. And he couldn't find any other oil company that was trading at those types of valuations anywhere in the world. And I think very quickly the stock kind of tripled and so on. They held it for a few years. It was a big home run. That's an example of things not making sense.
Yeah, Mohnish not exactly have the numbers right. I actually made a video about this investment of Buffett's. I will leave a link to that down in the description. But the free cash flow of the company was actually more close to 6 billion. So it was around 6 times free cash flow. And he actually made 8 times his money in only about 5 years. So it was a pretty good investment for Buffett. One of the best investments, in my opinion, in his later years. But like Mohnish talks about, that was a good example of a ridiculous pricing that only took a couple of years to correct itself. Of course, it helped Buffett that oil was around $30 a barrel when he bought into Petro China, and when he sold, it was around 90. But still, a pretty good bargain. And when you look at a case like Petro China, you do wonder if the big Chinese companies today are trading at ridiculous valuations or if they are a value trap.
And I think 4 years ago, I was in Istanbul, and one of my good friends is a value investor based there. And so I visited in 2018 and then again visited in 2019, and he took me to a business. And when we were driving over, he said the market cap was $16 million and the liquidation value was $800 million. I would call that an anomaly. Something trading for 2% of liquidation value. And he said it's basically a REIT. They own warehouses. They're the largest warehouse operator in Turkey. And he said that if they sold all the warehouses tomorrow, they would get about $1 billion. And there's about 200 million of debt. And so you would end up with about 800 million, and the market cap was 16 million.
So Reysas is one of Mohnish's most famous investments in later years, and it was a total home run. You can see when he invested initially, the company had a market cap of 16 million. I think he was able to put a couple of million into that. Now, the company today has a market cap of 15 billion Turkish lira, which is about 500 million US dollars, which means that Mohnish made a 31x on his money in only a couple of years, which is pretty amazing.
More than 20 years ago, I noticed that there were two funeral services companies that were showing a PE of 2. And the reasons are that nobody wants to go in the funeral home business. They want to go compete with Tiger Town, but nobody wants to open a funeral home. And basically, it's in a way recurring revenue, right? So if you have a funeral home in a community, generally families will want to go to the same place. And the other thing is that when your favorite uncle has passed away, you don't call 6 places trying to get the cheapest price on a casket. And so those are all characteristics of a great business. So I said, okay, I know that funeral homes are a great business. Why are they selling at 2 times earnings? Because, it's so stable. I mean, I don't know who is going to die in Peoria, Illinois next year, but I know how many are going to die, right? So it's a very stable business.
That's another good point from Mohnish, is something that I think is a good idea to look out for when you're trying to find the new businesses to invest in, which is something that I've not been following personally, but I like to invest in exciting businesses. But you could probably get very good results if you invest in businesses like funeral homes, which are not deemed exciting by the investing public. And usually the pricing is much better than in the exciting businesses like AI or semiconductors. So that is definitely something that I have to implement into my strategy going forward, is to look for boring but predictable businesses.
And so after doing the work, I bought the stock and I was buying at $2 a share. And about a year later, it was $10 a share, And we were in and out in about a year or 18 months.
So you can see these incredible returns he made in the stock in just 1 year, where he 5x'd his money. That is something that I've personally never done, but I do believe if I continue to learn from great investors like Mohnish, I'll be able to take advantage of an opportunity one day where I can get similar returns.
Another place where some of these things show up is 13F filings. So, there's professional investors who have over 100 million invested in US markets have to every quarter disclose what they own. And so you could look at the Berkshire Hathaway 13F, or you could look at Bill Ackman's 13F, or whatever investors you admire. You can look at their 13F and you can try to reverse engineer why did they buy that stock, right? So why does Bill Ackman like Chipotle? Or why does he like the railroads? And it's in many ways, it's investigative journalism, which is a lot of fun. So basically you go down a rabbit hole to try to figure out what was the reason.
So 13Fs is something that I've been looking at every quarter for a couple of years now, and I've learned a lot from it. I made a video on the channel about the latest 13F for the super investors that I track. I will put the link to that video in the description. But like Mohnish says, it's really fun to go over these 13Fs and try to figure out why these investors are investing in the companies that they are investing in. Because sometimes it doesn't really make sense from our point of view why they are investing. But I guess that's why they are professional investors, and I'm an investor just speaking to you on YouTube.
How do you go about thinking about like diversification versus betting a large on just a few high quality names you really believe in?
Yeah, that's a great question. So Charlie Munger says that if you owned the Ford dealership, or partially or completely the Ford dealership in Peoria, Illinois, and you owned the McDonald's franchise in Peoria, Illinois, and you owned the best apartment building in Peoria, Illinois, and those were the only three assets you had, and you had like kind of 1/3 in each of them. And basically, and you could have partial ownership or complete ownership, either way. Let's say those were all listed businesses, for example. He would consider that a extremely well diversified, good portfolio that would likely do really well for you. So if you were, going to look at a portfolio of stocks, I think once you get past about 10 stocks in a portfolio, there are diminishing returns. You're probably going to hurt yourself more than you're going to help yourself when you buy the 11th business, because the 11th business will not be as well understood by you as the number 2 business in that portfolio. And when you go from 10 stocks to 50 stocks, for example, you don't gain that much with the diversification. So what I have always tried to do in my funds is basically I set an upper limit from a cost point of view of 10% in a single position. But I don't trim the position if it grows. So like, for example, when we were buying the REIT in Turkey, we put the 8 million or whatever in, and that becomes 150 million or something. It hasn't been trimmed, because even if it's valued by the market at 150 million, it's actually worth about 450 million based on the current liquidation value of the business.
I think while Mohnish makes a really good point there on over-diversifying, I do think investors like Charlie Munger, Buffett, Mohnish Pabrai, and other similar investors are just really good investors. So they do get away with only owning about 3 to 5 companies. But I do agree more with the Francois Roshan point of view, where we can't be as good as these guys. So we have to be more diversified. For me personally, I would like to have about 15 to 20 companies. I currently have about 9 in my portfolio, so I'm looking to buy more. I just don't think that most investors are good enough to have a very concentrated portfolio. And that's why we are diversifying and buying protection for ourselves. Of course, most investors should be investing in ETFs, but for those of us that want to pick individual companies, I do think that 15 to 20 stocks is the ideal number. If you go much over 20, if you go, for example, up to 50, I think you would see very diminishing returns. So at least my personal strategy going forward is going to be a more diversified strategy than it has been in the last couple of years. But that's it for the video today. I highly recommend that you go to the link in the description and watch the whole thing. It's really a good video. But I want to ask you to smash the like button and subscribe to the channel if you haven't already. I want to thank you for watching, and I will catch you on the next one.